myself. But,
Try to keep the fort down, you know? I mean, if there's any problems, I'll find you.
Okay.
Thank you, Fred.
Oh, is that what,
With Peter Hand.
oh, Peter Hand's awesome.
Yeah, I was like, so I looked at the information and looked up the map of the zoning. I said, I just wrote a lot of notes down. I said, whatever he asked, I said, yeah, this is what I found.
I had fun with that.
Everything else, I know I had fun with it too, but I was looking at it, I said, okay, what's this DDR1 thing? And then I had to look that up and see what that means. I said, I think you could put it right there. And I was like, I said, well, you know what, he'll tell us what it means.
He'll school us. He'll school us.
Well, yeah, he'll school us, he'll tell us what it means. I was like, I said, okay. But other than that, it's been a week.
He's a chill. We did, I was in the last stage. We used to have a class on Tuesday, Thursdays, or Saturdays. One of the Saturdays.
Yeah, exactly.
So I
Exactly.
out on the road and did my wind therapy. But, so I had him on a Tuesday, Thursday. So we did this thing at the Gallery Mall. They're going to build up these, I think it died. I have a father there. But they're going to build these condos around the mall.
Yeah.
And so we went there. And I had problems. So I come back. But anyway, so we met for our final exam. We met at the PF Chang's.
Okay. Nice. Nice.
He's like, okay, so your final is going to be, but he just gives me. So you're all right.
He was like, because even today I was like, saying, I said, I'm looked, but it was nothing to write in, but he said just be prepared to talk about it. And I was like, okay, what's going on? I said everything else. I said it was nice to look up the stuff, and I was like, and of course, you know, you have to blow up the map. I said, maybe it's this, maybe it's that.
Did he tell you his book, Getting TS?
He did, but I have that book already.
Yeah,
I read the book already.
Yeah.
Oh no, yeah. It's like it's one of those like hardcore sales books. Like, no, you know, it's like, well, don't you believe in doing this and this and this and that? Well, why don't you want to do this?
I gotta tell myself I remember.
No,
I got that one, and I got the Art of the Deal.
The Art of the Deal.
Yeah. But I haven't read either one of them.
Yeah, I was like getting to yes, I have, but I forgot when I had it. But I just haven't read. I read it, and then I was like,
I'm going to just a little weekend. Right before.
oh, dude, you're gonna sit there and get people riled up, dude. You're gonna get people riled up.
Different.
You're gonna get people riled up. He was trying to get people riled up last week.
Yeah, that's
And I just laughed my ass off. 46. Yeah.
Now, those dangerous spots, right? Hey, Woody, if you guys start changing around, like, then I can't remember. No, that's okay, I got you.
But to me, I just go.
It's hard to forget.
That one's amazing shirt.
Yeah, this way.
Steinmark special. My wife got it.
Is that back in style, like Paisley?
But help me
Paisley's
understand.
style?
Only in the Grove. Only in the Grove.
Oh, I was like, maybe I can pull out my ties from like
Do it.
Like the 1970s.
Do it.
But it's more than just.
At least the AC is on today, that's a good thing.
How are you?
This is you. Okay, well, they're welcome down, we all face it.
I can't. I know what you're doing.
Exactly.
You're the first one. I'm letting you know. I don't play that. That's just.
Me too. It's been 3 months.
I was a lot of respect. I'm never ever gonna disrespect somebody. You see it from a perspective that I can never see it from.
I only got 70%. I should take more
All right. Good morning.
Cannot.
Good morning. It's 8 o'clock. Starting. Whoever's not here isn't here. Miriam, you're here. Canelo, no. Carlos here. Isabel, did I just see Isabel? Did I just see Isabel walk in? That's what I thought. B.
It was just for my, but I did it when I was trying to
Evan,
figure it out.
that's you, right? Yep. Bruce Fleming, Jarvis, Harry. Here. I saw you. RJ? No RJ, oh, he's not here. Eduardo, I saw you. Luis, I saw you. Juliana, I saw you. Angelo, Jack, Daniel, I saw you. Amy, no, I don't. Michael, Diego, Chris, I saw you. Grant, Michael Withrow, you're here. Okay, hey. Hey, good morning, everyone. Good morning. Good morning. Nice to meet you guys. Good morning. Good morning. I'm trying to get the chatter out so that we can take advantage of the 3 hours and 59 minutes that we've got, so we can get moving. Okay, so it's been an interesting week for me. I'm sure it's been an interesting week for all of you all. Maybe I'll share some of what I've been through. But anyway, in the meantime. I just want to summarize what we did last week, right? We went over the class outline, we went through what the expectations of the class were, and we really just got into the material by going a little bit over what the abbreviations and terms that we would use. Which a lot of these terms are things that, especially those of you who've been in the program for a year, should have intimate familiarity with. Now, I just want to throw out, there was really not like a lot of feeling on my part that people had done the advanced reading. Okay, just take advantage. There's not a lot of preparation in this class. I wonder how many of you took a look at the videos I sent this week. I got a lot of questions from one student on the Excel spreadsheets, but from one student, not from any other. So, I mean, that's there for you. You're not going to be tested on it, maybe not, maybe you will, I don't know. But I put it out there. I can tell you this, I've been teaching in a program, like I said, for 9 years, and if there's anything that I've seen that students need to continually work on, is to perfect their Excel skills. If you are not like an Excel wizard in this industry, you're going to be limited. So anything that people put out at you, anything that, it's information that's given to you, is going to be beneficial, okay? And to sit there and look at somebody going through keystrokes is very helpful. So anyway, so that's all out there for you. I didn't get any questions on the lease section. I didn't get any questions on the development costs. So I don't know if you people are watching it. I can see if you're watching it or not, just so that you know. I can see who logs in or not. But if we sit here and we go over leases, I might spend 15 minutes on leases today. I used to spend 4 hours on it, and it's a critical component of our real estate transactions are structured. Okay, so we don't really get our hands behind that. We're limiting ourselves in our ability. So I say that. What are we going to accomplish today? Well, as much as time permits. I'm prepared to go through a little accounting primer that I like to go through, a little bit of who an accountant is, what he does, how he does it, what kind of reports he puts out, just as a baseline so that we can then start getting into analyzing. Can't do accounting in an hour, okay? Can't do accounting in an hour and a half. We'll move through leases, and hopefully if time permits, we'll start on development costs, okay? So there's several key areas. We'll talk about that. I'll summarize that in a second. There's several key areas where there are specific nuances where real estate accounting is different than accounting for other entities and ventures. I need a computer down, please. Thank you. Where's the 10-year Treasury today?
3.09 the other day.
But that was the other day. Where is it today?
Friday or
Thursday or Friday? We don't know. That's the most critical question. I started going through this the other day. The 10-year Treasury is the most important benchmark that as real estate professionals we can follow. Why? We talked about the risk-free component of the 10-year Treasury the other day. Was it why are Treasuries risk-free? Right? Was it because the government had an ability to essentially repay it, right? But that should be the benchmark. Then everything else as an investment should be some sort of increment from that. A 10-year Treasury happens to be a midterm, happens to be a timeline that a lot of real estate investment funds target, And so, from my perspective, it's the most critical of the one indicators that we should look at every day. So, it affects, I'll get to that, Eduardo, it affects the interest, it affects the credit markets, it affects the stock markets, but it affects cap rates. And it affects the cost of capital for a real estate developer. And so, if we don't know where that's at, so I left early after a football game last night, so I don't know where it wound up and closed, and I didn't look at it when I saw the papers, but it had gone back up to like 3.05, but it had gone up like 10 basis points in a week. That's a huge move. It's at the highest that it's been since 2011. If you look at it from residential terms, and a lot of people, you know, feel intimately, right? We all know about home values and what it costs. Mortgage applications fell for the 9th straight week last week. And I'll get through some of the articles that I've read today. All of a sudden, the easy money, the cheap money is gone. What's that going to mean to values? What's that going to mean to people's ability to buy things? We can definitely look at it from a residential perspective, right? But when we look at commercial, which is what we're trying to study here, hopefully, it has the same implications. So if debt is 70% of the capital stack in most real estate transactions, probably anywhere from 60 to 80, cost of that debt is going to be an integral component of what our return expectation is. So if we don't look at the paper and see what it is, I mean, man, like how do we go to a business meeting, right? So anyway, Eduardo, you had a question.
Yeah, one of the articles that I read for the assessment was for Mercedes-Benz.
Okay.
They are paying 2.5% on bonds. I didn't understand that because it's risky, kind of risky.
Yeah.
And pays less than the Treasury. Or,
right.
Or
so,
the inflation is there.
So, no. So what is the benchmark interest rate in Europe? Is there one? Is there one? Is there one?
The Libor?
Let's try door number 2. So Libor, what's Libor stand for?
London Interchange.
The London Interbank
Interbank.
Offered, right? Offered, right? Okay, so it is essentially like what we would call the Fed funds rate in this country. It would be the rate at which banks loan to one another, and I can't get into why that is an interesting rate to follow. But no, it's not Libor. The equivalent to the 10-year Treasury in Europe is the Bund. It's the 10-year German Treasury. Okay, and curiously enough, that's kind of, I don't know exactly where it is today, but I think it's paying something like 11 or 15 basis points or something like that. And so you say, oh, how can that be? Well, the markets value that's more solid, essentially, than the U.S., or said a different way, compared to all of the other investment alternatives that exist in Europe. And that's what's happened in Europe is in Europe, people have preferred for the last 4 or 5 years to essentially accept a negative rate of return because of the security that some of these instruments have offered. Stop to think about that. For me, I would rather give you 100 cents and get 98 back in a year because I know I'm going to get 98 cents back than to give you 100 with the expectation of getting 110 next year. Okay? And so why Mercedes, which is a German company, right, is able to issue bonds at 2.5%, it's because the risk-free rate in Europe and in Germany in particular is essentially at 0, and it has been for some time. Now it's moved up, but it's still significantly lower than what it is here. Does it make sense to me? No. Does it make sense? I mentioned the other day, I read this thing every couple of weeks called the Grant's Interest Rate Observer. Does it make sense to me that we should be buying debt at a negative return? No. Does it make sense that we would be buying debt at historic lows? No. Especially those of you who know that there's an inverse relationship that exists between interest rates and debt prices, right? And bond prices, right? So if interest rates are at historic lows and they've got no place to go but up, there's an implication that holding a long-term debt instrument, the values of that are going to go down. So unless you hold it to maturity, you're going to have a capital loss. So anyway, I don't want to get into, that's a separate class. I don't want to get into that, but that's a good question, okay? And a lot of a lot of companies have loaded up on debt in the last 2 or 3 years, just because the credit markets have been, you know, so sort of forgiving, you know, so, anyway, all right? So 10-year treasuries are like 3.05, went up like 10 basis points. That's a huge, huge move. Credit markets don't tend to move up that, and that does have implications on the real estate market, okay? It does have implications on the real estate market. I didn't read the article, I just saw the headline. I thought it was kind of interesting this morning. I wrote a little note down, and there's a guy who, he was, apparently was one of the creators of these collateralized debt obligations at Merrill Lynch back in the early 2000s, and he's kind of reinvented himself at a hedge fund now, and he's doing something called ISAs, which are income sharing agreements. So what they're doing is they're financing student debt or financing higher education to students in exchange for, you know, their future income. Kind of like what sports agents have done with athletes in the past, where they'll, you know, they'll finance your car or whatever it is they're not supposed to do, but then they get a percentage of what you make in the future. There's now a hedge fund out there that is investing on you. Imagine that. Hopefully it's a good investment.
What is ISA stands for again?
Income sharing agreement. So I just saw that this morning and I thought, wow, maybe that's the future of... Sorry? Oh, it appears to be, yeah. I've never heard of it. I mean, I've heard of it in the context of sports, but I've never heard of it in the context of education. And so, kind of interesting, you know?
How?
I didn't read the article. It's in the Wall Street Journal today. I didn't read the article. But if you go to it, I just saw the headline and I thought, wow. Anyway, listen, I'm going to start. I'm going to give about 10-15 minutes of stuff that caught my attention this week, okay? Hopefully I'll tie it back to real estate somehow, but I started going through this. There are new features coming to Excel, and I keep going back to, I mean, I was never an Excel guy. I grew up on VisiCalc and Lotus and stuff like that, but that's an incredibly powerful tool, and I know development businesses that don't use Argus, okay, don't use other tools, they use Excel, because it gives them flexibility that they don't otherwise have. And so I know in my particular, you know, business experience, we always used Argus and then we dump results and manipulate it with Excel. And so if you don't have good Excel skills, my recommendation is to develop them. And the best way to develop them is to practice. It's to challenge yourself. Okay, so interesting tools. There's one, I found an app the other day that's very helpful, and it seems like this is going to replace it. I found an app that pulls stock prices directly into a spreadsheet. And that was a problem, because I used to have to, like, pull prices from a program on the internet, dump them to Excel, and then try to match it. But now it's going to be embedded in Excel. And then there's another one with geography, so you'll be able to pull up countries. It'll give you, populations and average temperatures and stuff like that. So, listen, it's important to stay up with technology. I remember asking when I was a young auditor, they made us use Lotus in our audits. So you're thinking, whoa, what do you mean like that? So yeah, it used to be that we used to do everything on paper. I'll talk to you about accounting. I grew up in my dad's accounting practice doing general ledgers and journal entries by hand. Okay, people, how can you do that? With like 24-column paper. Yeah, I mean, that's how things used to be. I'm not old enough to have used an abacus, but I mean, there's stuff like that. And so, but I remember asking this partner saying, listen, why do we have to use Lotus? Because it's going to take me more time to do this on a spreadsheet than to do it manually on a lot of the smaller audits. And he said, you can't, once technology comes, you got to get on the bandwagon, because it'll leave you behind otherwise. And so I say that to you, and I'm saying Excel, but really it's anything. There's this whole sort of wave coming with all this artificial intelligence and the application that's coming to a lot of businesses. People are using or trying to use it now in retailing, which has a huge real estate impact, right? And so just stop to think even from a real estate perspective. I think that was one of the articles I had last week. It's a couple of these large REE mall operators are trying to use artificial intelligence to understand what? people's patterns, what they do when they go into a mall, what attracts them, what they might react to, what might be because at the end of the day, if you're the mall operator, what do you want? Do you care about people selling stuff or not? Or buying stuff? Do you care?
Yes.
Why?
Keeps the leases.
It keeps the leases, well, I would say there's two reasons. Most retail leases have a what component in it, do we know? Has a percentage of rent. So the landlord is going to benefit directly to some extent from the revenue. But more important than that, most retailers in their model have a relationship between what? Well, the cost per square foot and the revenue that they generate, right? So you're going to find that, you know, a store on Fifth Avenue, New York is going to be able to pay X per square foot. Why? Because they could sell, you know, this huge number. Now, if you're in Tupelo, Mississippi, or Cleveland, Tennessee, are you going to pay the same rents? No. Why? Because there isn't the same foot traffic. There isn't the same generation. And so, you know, a lot of times we don't really want to get concerned as real estate players with what's happening in the underlying business, but that underlying business has implications on our revenue stream as well. Okay, so, you know, keep up with that. I just talked about this, I'm not going to go through this, but the era of low mortgages is over, okay? Home mortgages are actually at a 7-year high, okay? Michael, I think it was you had a question the other day on how hedge funds carried interest on the financial statements.
Oh, yeah.
And I could not find, curiously, I could not find any literature on that. What I did find was a lot on how they mark to market, okay? And actually, the reason it sort of triggered the research on that, the AICPA has a new working draft on, it's called an accounting evaluation guide, but it ultimately talks to how do hedge funds carry their interests. And so once you get beyond, so my thinking is, to your point, is the company itself. So they're looking at the investor's view, and that's what I found guidance on. I didn't find on the companies, but you know, my perspective on the company, right? It's going to be a book entry where they're going to have to recognize, right? Essentially, I mean, there's zero impact on the trial balance, but they are issuing shares, right? To your point, so they've got to recognize the issuance at a zero valuation. There's no capital paid for that, and as a consequence, there's no cash coming in. But they've got to recognize that the equity is out there. Okay, so I don't know that that gives you 100% of the answer, but I really.
It's just interesting to know.
Yeah, but I mean, listen, accounting, as we'll mention in a little bit, is historical cost-based, or at least GAAP. Generally accepted accounting principles require us to record our financial statements on a historical cost basis, not on a fair market value basis, although we have some valuation adjustments we'll talk to, okay? This is an interesting thing. I get a newsletter every week from a mortgage broker out in LA. I have no idea why I get it, but it must be from one of these like real estate places that I get you know, junk from. But what I find interesting is they always highlight every week some of the transactions that they did. And for me, that's an input on where the credit markets are, what things can get done, what things can't get done. So I'm just going to go through the one I got this week. We don't have to spend a lot of time on it, but you're going to start hearing buzzwords, some of which are things we've talked about or we'll talk about in this class. Others are things that you hopefully have talked about or will talk about in other classes. So, for example, there is a $33 million, I'm just going to go through it, bridge loan, construction financing on a hotel. So what's a bridge loan? That's not a mezzanine.
Oh,
It's just a temporary financing structure, typically about 12 months to get you through a gap between a purchase and actual financing.
Hold on, one
I
at a
know
time.
in theory, but in
Okay,
practical.
okay. Well, I mean, you've got some components. Well,
Actually, putting up something is the loan that we get, you know,
to bridge you, right? We can't use a description, but
yes.
it's kind of, it's a link between, yes, Jarvis.
No, I was gonna say like between that and long-term financing.
Yeah, or permanent, we call it, yeah,
permanent financing.
yeah. So typically in the real estate realm, we have construction financing, right? Or acquisition, development, and construction financing. I haven't seen that in a while, but it's one of the terms we had the other day, ADC, acquisition, development, and construction financing. So we've got financing arrangements that financial institutions will provide for us, which are typically short-term in nature and variable interest rate. Variable interest rate. Why would they use variable interest rate?
It's risky, because it's a risky loan, or not.
No, let's try.
Just that it's not fixed, I mean, it's right.
Yeah, but why? Yeah, but why variable on a short-term loan and not? Yes, Jarvis.
Because the project term, like a project, the term of completing a project from construction kind of varies in a sense, where you can have like a 2-year time period to build, but it might take 3 years or something like that.
Well, I mean, I would sort of argue that if we know that it's short-term in nature, you should know what the interest rate environment should be. You theoretically should be able to fix it, because as a lender, you shouldn't have that much exposure on interest rate.
Well, they're interest only payment.
Well,
The ones I've been.
they typically, why are construction arrangements only, but this is all, we need to know all this stuff. And I used to cover all this stuff in this class, so let's go through it. Why are construction arrangements interest only?
Because cash flow.
Because businesses don't have the cash flow to pay, and because they don't have the cash flow to pay, how do they pay the interest? Oh man, how do you pay the interest on construction loans?
I guess the interest is paying based on the money that we receive.
Are you talking about like draws?
Yeah, how do you pay interest on a loan if you don't have cash flow?
They deduct from the.
Well, from the loan.
You deduct it from the money that they give you.
Yes.
No, from the down
From the
payment,
principal.
from the equity that you give in the beginning, is that?
You don't have money, you're not.
Paying it.
Oh, it's fixed.
Okay, so most construction,
Usually building their.
listen, most construction loans have what's called an interest reserve built in, okay? All right? What's an interest reserve? So you need to borrow $33 million to loan something. The interest is going to be, let's just say something during the term of the loan, $3 million. As long as the bank or the lender can underwrite, in other words, can get comfortable with the loan to value, they'll loan you an extra $3 million. Okay, so they'll loan you the 33 for the construction. Okay, and they'll loan you another $3 million for the interest. Why will they do that? Why would a bank loan you money for the interest?
Because they know that
They want to be safe, they wanna
More money.
make sure you're gonna.
Well, they can make more money, but what do you mean be safe, Luis? Okay, so,
they know,
well, because they need to get paid. Why do they need to get paid? They know you can't pay them. You don't have the cash flow to pay them.
But they're getting paid with their own money.
Huh?
They're getting paid with their own money.
Well, so they're making more money because they're loaning you more money.
They know the loans,
But there's,
it's gonna turn into perm debt, so they know that once that loan converts, that their lender's gonna get paid off.
they don't know that.
No, from one lender to, or
They're
else they
hoping.
do know that, or else
They're
they wouldn't-
hoping.
or else
No,
they
they're
wouldn't have underwritten
hoping.
it.
They're hoping. There's a very simple reason for that.
Minimum.
Banks are regulated, and banks need to classify their loans. And what do you mean by classified? Performing, non-performing, past due. So, if a loan is not current on interest payments, if a loan is not receiving money, it needs to be classified. And by being classified as non-performing, the bank then has to create a reserve against it, an uncollectability reserve, which is going to impact their equity, it's going to impact their results, and it's going to impact their ability to loan more money to other people. So from a pragmatic perspective, they need to pay themselves, so they create an interest reserve, they make more money because they're loaning you more money, right? And their loan is then current, okay? So, back to the thing, what's a bridge loan? A bridge loan is one that's going to get us from a construction, right, or acquisition period into what we would call permanent financing. Okay, now, we still didn't answer before we get to permanent financing. Why are construction or short-term loans in real estate typically variable rate.
So when the Treasury changes, they don't lose money.
Why is that?
So as it moves up and down, they're always getting the same
Okay.
performance.
You're kind of beating around it. It's a matching issue. Lenders have to match their source of funds, their liabilities, with their assets. What do banks finance themselves with primarily? Our deposits. Our deposits at the bank are what? Are the bank's liabilities. Our assets, our deposits at the bank, are the bank's liabilities. What do we get on our deposits? Interest, an interest rate. Yeah, I mean, we're living odd times, but it's
Theoretical interest rate.
an interest rate that varies with because we expect a market rate, right? So it's a matching, okay? Now, with permanent, I don't have time to go into all of this. There's two typical types of lenders that provide real estate financing long-term. Historically, who provides long-term financing for the real estate industry in this country? What
Insurance.
Life insurance companies and
Pension fund.
pension funds. Why would institutions like life insurance companies and pension funds loan money to real estate ventures?
Because it's more stable.
Well, let's go back to the matching. Woody.
They have long-term obligations.
So they have people give a life insurance money to get paid hopefully somewhere in the future when somebody dies. So they've got long-term liabilities which they need to match with long-term assets. They typically have an expectation or provided some sort of indication or guarantee of returns, and hence they've got to match those obligations with assets. Okay? So we typically see historically commercial banks providing short-term loans for construction at variable rates, and we historically have seen life insurance companies and pension funds provide long-term financing to real estate with fixed rates. Now, listen, this isn't in a textbook anywhere, so take notes if you want to learn, or listen. That's all changing. Number one, that's all changing. The lines are blurred, right? So there's mortgage REITs out here. I mentioned some the other day. People like Blackstone and Ares Capital and Apollo that are providing permanent or semi-permanent financing. They probably don't go out more than 5 or 7 years, but they're starting to get out there. There's hedge funds and other shadow financial institutions. There are banks that are doing longer-term financing. Okay, and what they're doing is using interest rate swaps to protect themselves. Okay, you're seeing life insurance companies providing construction financing. All right, so the lines are kind of blurred. You've got the whole conduit or REMIC or securitization, the whole securitized market, okay? Securitized loans, so, people are creating financial instruments out of mortgages and selling it to investors, okay? And so there's a whole evolution in what's changing here, but short-term maturities, variable rates is a historical sort of, precedent and norm. Longer-term financing, fixed. What do you need to have in order to have permanent financing for a real estate asset? Now we'll answer what bridge means. What do you need to have in order to provide permanent financing?
Stabilized property.
So you need to have some sort of stability of cash flow, okay? Because a lender needs to be comfortable with what? Repayment, right? At the end of the day, probably the biggest, banks have a lot of different risks, but probably the biggest one they have is default risk, that you don't pay them back. And so in order to provide financing for a longer term, you need to have stability of cash flow, right? So if you've got stability of cash flow, then a bank feels comfortable in saying, okay, I can give you a loan for a while. What provides stability of cash flow? We're going to come back and revisit all this stuff later in the term. What provides stability of cash flow in a commercial real estate environment?
Credit worthiness.
What underlies credit worthiness? Income. What provides the income? What generates the revenue? Leases. So ultimately, a lender gets comfortable with providing permanent financing for real estate because of the nature of the underlying leases, which provide the income or the revenue for a project. Okay? And so why would someone be somewhere between construction and permanent? Why would they need a bridge? Well, maybe somebody's bought an asset that isn't stabilized yet. Maybe they bought an asset that they need to do some rehab on. Okay? And they can't get permanent. Is that what you were going to say, Miriam? Oh, okay. Were you going to say something else? It's okay. Okay. A lender maybe cannot provide that sort of comfort feeling, right, to a lender that they can pay back the loan over a longer period of time. But they may not necessarily be in a construction loan. So, you know, there are people out here that provide this bridge financing to get you somewhere from here to here. Now, what would we think would be the cost of that debt? Huge. Well, it would be higher typically. It would be a higher cost. Why? Because there's uncertainty. There's uncertainty. So this particular loan is Libor, going back to Libor, okay? Libor plus 535 basis points. So in this particular case, it's what's the term? It's a 3-year loan. 3-year Libor's at about 3%, something like that. So these guys are going to pay 8.5%. You know, in today's environment, that's a pretty, high rate. Yes?
Just typically, do the bridge loans have a prepayment penalty? Like, let's say they do the 3 years, but they can finish their project sooner.
Okay. I was going to jump to one of the next examples, but I'll answer. No, I'll answer that. So typically, because again, from a matching perspective, short-term debt typically has no prepayment penalties associated with it. Okay. So let's kind of go back. See, this is the kind of stuff that I like because this pulls from this capital markets class that we have. One of the problems that so we always think of debt as the creditor, right? We borrow money. Most of the time we don't think as the debtor, as the guy that loans the money. We typically, most of us, now we've got, we may have bankers here, we may have, I told you I've had people here that are like hard money lenders and stuff like that, but for the most part we typically think of debt from the creditor perspective. And so from that perspective, what do we want? We want the ability to prepay debt whenever we want, under whatever condition we want, right? Just think about our home mortgage. And typically in this country, home mortgages have always, been freely prepayable, okay? Most home mortgages in this country have a 30-year term. Most Ginnie Maes, and I just use that one as a frame of reference. What are Ginnie Maes? Ginnie Maes are securitized instruments which are backstopped by FHA and VA loans. So, but mortgages. So, but it's an indicator of the lifespan. Most Ginnie Maes in this country are fully paid within 7 years, even though in the maturity on mortgages, on most mortgages is in this country is 30. Why is that? No. The investor by 7 years is fully repaid. Well, how can that be?
Paying interest up front.
No, because in this country, 20% of the population moves every year. Because most people don't stay in their house for more than 4 or 5 years. Because people die, because people get married, because people get divorced, okay? Because kids move out of the house and people downsize. So, because most people don't stay in one house for 30 years, okay? And so, most mortgages, there's this whole, I forget the term that's used, it's not mortality, but it's something like that. And there's statistics on this. Most home mortgages don't see, the end of their cycle. Now, there's one other reason why people would prepay a mortgage. Why is that? Let's say I'm staying in my house, but why would I prepay my mortgage?
No, your payments.
Get rid of the interest.
Because all of a sudden, interest costs have dropped. So when you've got reducing or lower interest rates that are lowering, it's going to be beneficial for the creditor to do what? Refinance. Especially if there's no cost associated with it. Okay? And so, in times of lowering interest rates, people prepay debt. Now, what happens if you're, now put yourself as the debtor. There's something called reinvestment risk. Okay, I'm the debtor. I loaned you $1 million at 8%. Interest rates go down to 6% and you pay me back. Now I got $1 million. What can I reinvest that at? 6%. Who got the short end of that stick? The debtor, right? And so, to prevent that, there is something known as call protection. Call protection. So you can call the debt, but there's a cost associated with that. So, in this country, in commercial real estate, most short-term debt obligations do not have any call protection. Do not have any call protection. I'm talking about commercial now. Most residential mortgages in this country have no call protection whatsoever. They're fully, prepayable without any cost. Now, in commercial real estate, most permanent financing does have call protection. And that call protection, and I'm not going to get into the details of it right now, come in 3 or 4 different type arrangements, okay? The first and foremost is something called the lockout period. What's a lockout period?
Period of time you have to
You
hold on to the
have to
property.
wait before you.
I'd phrase that differently, but yeah?
It's depending on which industry you're talking about. I know if you're
Period of
in
time
stock,
you're
if
not allowed
that's
to
stock,
prepay the debt.
if you got stock in the economy.
In real estate mortgages, okay, I mean, you can extrapolate a lockout period when you're an insider on a stock transaction to a mortgage. Well, I'm talking in a commercial mortgage, what's a lockout period?
Period of debt that you're not allowed to prepay.
It is a period in which you are unable to prepay a mortgage. So, most commercial, long-term, fixed-rate debts and debt instruments in this country are going to have a lockout period.
Unable, or you just gotta pay a fee?
You're locked out.
You're locked out.
Locked out. Now, these are all negotiating instruments, so typically for 1 or 2 years, you're locked out from prepayment. So, what is that forcing you to do? Saying, listen, you're buying this for the long term. So, buyer beware. If you think you're going to sell it in the first 2 years, don't get permanent financing. Do a bridge type arrangement, right? Look for another shorter term, form, right? So, first sort of level of protection is a lockout period. You are precluded from prepaying the mortgage, so you have to own it, come hell or high water. The second one comes in, some sort of prepayment penalties. You really don't see these things anymore, but these prepayment penalties might be, okay, in the third year you prepay, 6 months worth of interest or a year's worth of interest, and then you have some sort of scale, okay? What you typically see in this country are 2 arrangements. One is called yield maintenance, and the other one is called, does anybody know? Defeasance. Aren't you guys glad you're taking this class? Yield maintenance. So yield maintenance basically says you can prepay the loan, but you've got to put the lender back in the same environment. You essentially have to take away that interest rate risk from him. So, as an example, you have a mortgage that yields 8%. The prevailing interest rate is 6%. At the time of prepayment, you need to take the outstanding balance and essentially add that 2% component that he would have made over the remaining term of the lease, so that he essentially is going to get his 8% return over the lease term. So yield maintenance, you're essentially guaranteeing the lender that he's going to get his income stream that he signed up for. Why is that important to the lender? He's got life insurance clients that gave him some money that he's promised a certain return to. So when he gave you the mortgage at a fixed rate, he wants to make sure that he's getting a return in order to provide his customers. Okay? Now, that's yield maintenance. Defeasance is a little bit different, okay? But it's the same economic impact. Defeasance, you don't actually prepay the loan. And this is probably the most common one right now to see, okay? So defeasance, you create a trust, and in that trust, you fund it with strips, Treasury strips. I'm not going to get into what Treasury strips are, but Treasury obligations, okay, that essentially mirror the cash flow that that mortgage was going to provide. And so you got to create a trust. Say you've got 8 years left in a mortgage. You create a trust, you buy treasuries that have maturities exactly when each one of the payments that was due are due, in the exact amount that they're due, and then this trust, every month or every quarter or every year, whatever the obligation was, sends a check to the lender. And in exchange for that, they will release the mortgage. But they're not getting paid now, you're creating a mechanism for them to get the money in the future. And you say, why would that be? Well, in the case of securitization, there's no sort of lender, there's special servicers, and nobody wants to deal with this. So it's the obligations on the borrower to create this trust, and then just continue to make the payments to all of the holders of the different tranches of the securitization.
And
Okay,
is that funded by like capital gains or from
No,
the
that's
sale of the project?
That's
pretty much
funded by
like-
whoever is prepaying the mortgage.
Right.
When do you typically see that? When you sell the property.
Right.
So typically at closing, X amount of money goes into this trust to satisfy that debt obligation. The mortgage would be released, and there's a few companies out there, they're like Defeasance R Us or something like that. You know, I mean, they're kind of called something. They make it really simple for you. For a fee, they'll create this entity and they'll manage it for you.
So
They'll
from
go out
the
there.
proceeds of the sale, they.
From proceeds of the sale,
Okay.
they go to fund. So typically you get proceeds from the sale would go to fund debt repayment. This goes to fund this trust that is then going to buy these securities so that it can make the payments in the same structure as you were originally going to, had contracted to pay. Okay, so to your question, almost all debt financing that's long-term has some sort of call protection associated with it. And to Eduardo's question, dude, you just buyer beware. If you know, I'm in a deal now that for 3 years, they had sort of bridge financing on a real estate asset. I kept asking him, we're going to hold it long-term, why don't we make it permanent? So a year ago, they decided to get permanent financing. And now we're selling the property. And there's like a $6 million defeat cost of defeasance. Now, defense of the managers, they got a knock on the door. It's not like we marketed it. Somebody put, and they say, okay, even prepaying these $6 million or creating this trust with the $6 million, it's worth selling. It's worth selling, okay? But I can tell you that this becomes a huge obstacle in a lot of sales transactions. Okay, so there's a benefit to fixing interest rates on a real estate deal, but there are considerations, there are implications to everything that you do. Okay, so you take away an interest rate, unknown or invariability from the equation, but there may be a cost associated with disposing of that property in the short term. Okay, any questions on that? Does that make sense? Okay, there's other examples, but I'm not going to go with those because I think we kind of exhausted this stuff. We keep hearing, this is an interesting one. Best Buy executive speaks out against tariffs on Chinese televisions. So I heard it yesterday driving back from the game. So, what's a tariff?
Taxes, import tax.
It's a tax. Why don't we just call it a tax?
Tax on import.
Yeah, it's on the trade.
Yeah,
So
so in
it's-
effect as a tax.
Yeah, I'd say it's an imposition rather than calling it a tax. I'd say it's an imposition on an imported good.
In Spanish it's called arancel, right?
Un arancel, absolutely. So it is an imposition on an imported good. Why would a country impose a cost on an imported good?
Because it to make it harder to sell domestically, so that
So make it more costly
the national
for
buyer has
imported
advantage.
goods to come into a country.
Affect domestic companies.
To not affect domestic companies.
So, well, there's a lot of reasons why a country would impose these tariffs. So there's something that's in vogue which is called dumping. Have you ever heard of dumping? People say that all the time. What is dumping? Sorry, we've got a European, I have to be careful here.
When you sell for less than what it costs you.
Say it louder.
She did.
When you sell for less than what it costs you.
Okay, so I'm not gonna get, somebody asked the other day, we're gonna do cost accounting. We're not really gonna do cost accounting per se. But, when we produce something, we can ultimately, as accountants, talk about fixed or variable costs. What are fixed costs versus variable costs?
Fixed cost,
Fixed costs.
whatever.
So-
Fixed cost is independent of production.
So they are costs that you are going to incur independent
Whatever what.
of your production. So, I gotta pay, one, of rent. I have to pay 0.5 of property taxes. I gotta pay 0.5 of insurance, okay? I have to pay management regardless of whether we produce, and so on down the line. There are a series of costs that we have to incur or pay irrespective of what we generate in revenue or of what we produce. What are variable costs?
That's in unique products.
So those are costs that are directly tied
Production.
to my production. Okay, so for example, if I'm a wood cabinet maker, wood, right? Nails, glue, maybe razors for my, for my saws, right? Theoretically, the labor for the carpenter. Now, there's an argument on that because the carpenter's going to be there regardless of and what is it? Time finds as much work as there is to fill it. So if there's a lot of work, people work faster. If there's less work, people tend to work slower. But we're going to say labor, materials typically are variable. Okay, and so what happens is a lot of people use this sort of like marginal or variable pricing theory, and they're going to say, hey, we're going to sell at full price till we cover all of our fixed costs. So once our fixed costs are covered, we're just going to sell for variable. So what happens is a lot of companies will sell at full cost in their country and then turn around and sell only, to recover variable costs in another country. Okay. Other things that happen is there are entities that are subsidized to export. In a lot of countries, people get tax benefits or direct subsidies for exporting goods. There are places where you have companies that are government owned and there isn't a profit motivation. The motivation might be just creating employment. And so they sell at whatever the price. Okay, so dumping would probably cover all of these things. And so, without taking sides, the argument would be that in a lot of cases we see things like steel coming from China that our manufacturers are saying is being sold below the full cost. Maybe it's subsidized. Maybe we're less efficient here. Maybe it's, they're selling at a profitable level, but below what we can profitably produce it for. Okay, and so ultimately,
Is dumping also done in the health industry with
pharmaceuticals?
Right.
It's
Like they will
yeah, it's
cover
no.
the full
Yeah,
cost
so
here
yeah, so
and then sell to Germany because Germany is buying for their welfare state at a very low cost.
Yeah, so I think you can argue it's a similar concept. One second, Woody. I think it's a similar concept. I think the argument a lot of people in this country and in some of the developed countries that do, now for instance in Switzerland there's a fair amount of pharmaceutical, the local markets tend to pay a lion's share of the research and development costs. And once those are covered, a lot of the manufacturers or the distributors will sell at a lower cost, or getting rid of the R&D fixed component, right? You know, and they sell it cheaper in another country. Now, I don't think anybody complains about that because they're getting drugs at a lower price, and it's not putting anybody out of work. It's providing a common good. The theory in putting tariffs is that you want countries to sell product at a price that is competitive with what you can locally manufacture. Why? So that you can have jobs locally, number one, and number two, at certain industries, so you've got the capacity. Because at a certain point, I remember the example, this was mind-boggling to me. There's a tunnel that goes under the Port of Miami. I don't know if you guys know that. It's a tunnel. We spent $1 billion on it. We spent $240 million buying the boring, the drill bit that created that. We had to buy it from a German company. Why? Because there was not one company in this country that was capable of producing that. So, you know, you go back to, if you don't protect your industry, you're going to wind up with components of your industry that just don't exist. I don't think televisions are critical, but are there any manufacturers of televisions in this country? No. And, you know, we can go down the line of all the things. Now, I'm not an economist, I'm an accountant, okay? So the economists will tell you, no, the widgets need to go where they're produced most efficiently and all that. But let me come back to that in a second. Woody?
But, you know, the reason they put tariffs on everything is because all these other countries are deregulated. I mean, we have regulations that we can't even produce half of the products, and they have no regulations in China. They pollute their air, so it creates more of a fair trading.
Right. So the argument goes beyond the cost. The argument goes into, you know, defense of intellectual property rights. It goes into contamination of the environment. It goes into fair wages, you know, and equity and things like that. So I would say this. I ran the trade zone in Miami for 4 years. Now, these numbers are going to be a little bit outdated because it's been about 12 years since we sold that. But we had to produce a ton of reports. So we basically managed all the goods that came into the zone and went out. Now, this is a free trade zone, okay, where essentially goods would come in for re-exportation. So companies would not pay any duties or tariffs on the products coming in as long as they would be destined for re-exportation. And South Florida and Miami in particular is a transshipment hub. Goods come in bulk from Europe and Asia in containers and then leave here in less than containers. We've got a whole bunch of economies that exist around us that not one of which is significant in size, but collectively are. So if you look at, we'll export $3 billion worth of goods every year to Honduras, and $3 billion worth of goods to Guatemala, and $5 billion worth of goods to the Dominican Republic. Not one of those markets is significant, and they don't consume that. So they can't consume, a 53-foot container worth of clutches or brake pads. But if you're a distributor of aftermarket car parts in the Dominican Republic, you come to Miami once a month and you take a 20-foot container, and from this guy you buy brake pads, and from that guy you buy clutches, and from that guy you buy, nuts or whatever, or tires, and you consolidate. So that's how our economy exists, and that's why we're a big port city down here.
Is that what they call a transit cargo?
Well, it could be in-transit cargo. We're definitely a transshipment point. So, but where I was going, so at the trade zone at the time, the total tariff and duty value of the goods that were coming into our zone, which is to exclude tariffs, was less than 5%. And what do I draw from that is that we have really, over history, totally, unprotected all of our manufacturing. We have basically said, just bring whatever. Bring whatever, and as long as it's cheaper, we wouldn't let the market work here. And that's great, as long as there's reciprocity in the other markets. And we haven't had that. Which brings up, there's another thing that people throw around, which are quotas. And we haven't heard that thrown around yet, but what are quotas? Louder, please. So a quantity, so there would be a limit put on the quantity or the dollar value of things that can be imported. So that's the other way you can control trade. So you can say, okay, I'm going to put a 50% tariff on every ton of steel that comes in, or I'm going to say, I'm going to put quotas on steel from China. We can only take so many long tons or metric tons of steel from this country. And once that's full, that's it.
Do quotas apply also for exports or just imports?
Well, no, but other countries, and that's where there are typically, the complaints that U.S. manufacturers are going to have, I think, are threefold in most other countries. One is going to be that there's going to be tariffs that are unreasonable. Two, what applies a lot is there are quotas. So most countries will have quotas. And then the last one, which is difficult to measure, is it's very difficult to do business or get things in the country. So I'm looking at the Brazilian contingent here, okay? For example, it's almost impossible to take a U.S. good into Brazil. At the trade zone, we had a tenant that would bring Kawasaki motorcycles from Japan, disassemble them, strip them. It was a chop shop. They would strip them, put them in a box, and send them to the free trade zone in Manaus, rebuild them there, and sell them in the country as locally manufactured motorcycles. And they were cheaper than importing a motorcycle from Japan into Brazil. Try importing a new American-made boat into Brazil. It's impossible. It's impossible.
They did that same thing in Venezuela, because my dad used to work in Yamaha, but they did it to incentivize the local economy, so...
That's exactly that.
Yeah, not because it was
Well,
cheaper.
but that's... Well, no, it's to create the jobs locally, right? So you make it impossible, and don't get mad at me, guys, don't get mad at me, please, you know, it's just the way...
No, I'm turning up for you.
No.
I get mad at myself because I had to pay for that.
Okay. No, but I mean, but the exact, and listen, so I've got the American view on this, right? But and I've got Brazilian friends that grow crops, you know, and so when all those were saying, hey, maybe we should put, you know, quotas on soybeans or on orange juice coming out of Brazil, right? Whoa, we don't like that, you know? But it's difficult, and I can tell you, with boats, I've got a former employee that I had, I mean, for years he would come to the boat show in Miami, and it was impossible for him to realistically buy a boat here and take it down there. So, you know, the paperwork, the cost, the difficulty, and so there's a lot of different ways to do it. So, look, I'm all for free trade, and as if I were an economist, I would say we should let goods go to wherever they are most efficiently. We should let the markets allocate the labor and the materials. It makes no sense, for example, to import iron from somewhere to manufacture something, to take it back and finish assembling somewhere else. Maybe, you know, the steel should be made next to where the ore is mined, you know? Maybe that's the lowest cost. But then you need to have, you know, full openness in all of the markets in order, and equality of conditions, and, you know, defense of the environment and intellectual property rights and all that. Now, does any of this impact real estate?
Yeah.
How? Give me an example.
Construction costs.
Okay, so it could impact construction costs to the extent that we import, what do we import in this country for construction?
Wood.
Probably steel more than wood.
No more
Probably
Chinese drywall.
Yeah, I mean, there was some of that, but I mean, historically, steel has been, we've pretty much given up the steel industry in this country, and so most of the steel is imported. But how about from an ownership perspective? I mean, I was talking about transshipment. What does the city of Long Beach, California live off of? All the ships that come in from China full of goods, they get broken down and then redistributed in this country, right? So if you start reducing, right, the amount of containers coming in, it's going to impact the space that's currently available for lease, right? So I don't make you read the Wall Street Journal every day so that you take a quiz on Tuesdays, for those of you who took it. That's, take advantage of all the grading opportunities, please. So for those of you who took it, great, but it's not for that. And so that you get all this information and say, how does that impact my day-to-day? I mean, you know, should I worry about retailing? You know, should I worry about office and the trends that, you know, that are impacting buyers today? Should I worry about the way people work and the amount of space that they occupy? Should I worry about the distribution space, you know, and so on and so on and so on. I'll talk about this later. And a city in New Jersey just did eminent domain to condemn condemn some land in order to allow a shopping center to expand. Now, what's eminent domain?
For public use.
Government has the right to take your property and pay you for it if it's for the
Public.
use of the public.
Public good. Okay. So that's so in this country, the government has a right to condemn land for public use. Do they pay you for it?
Yes.
And how much do they pay you?
Fair market value.
It's the fair value.
Market value.
Fair market.
Praise value.
It's the fair value.
Praise.
Market value.
Fair value, appraised value, market value. What did if you want the best, my old boss used to say that eminent domain or condemnation was the highest and best use of land. If you get a good attorney and you push it, you typically can get, you know, and typically why do governments condemn? It's for things like roadways, to assemble things, you know, stadiums, things like. And there's a trend. I'm not an expert in this. I'm not a lawyer. I'm not a land use guy. I'm not an eminent domain guy. But there's starting to be sort of in the public-private realm, eminent domain, you know, from what I've read, situations happening for private sector projects. Okay, and that's all sort of an evolving world. I don't know, you know, how that stands up in a court of law where, you know, maybe you condemn something for a stadium that may ultimately be owned by a team owner or something like that, okay? And so, are there tax implications to that?
Yeah.
What are those?
I mean,
I own a piece of land. I paid $1 million for it. The
Right.
government takes it from me and they pay me $2 million. Is there a tax implication on that?
I mean, the tax basis, right? Like for that.
So
that
yeah,
piece of
so I
land,
got
property.
two and
Right.
I paid one, I made one, right?
Mhm.
I gotta pay tax on that. Does that seem fair to you?
No,
Why not?
because I didn't want to sell it in the first place.
Yeah, but I gave you the money.
They do give you 1035 though, if you want to wait 10 years.
1033.
Oh, 1033, I'm sorry.
Okay, and so similar to, and we'll talk about 1031s at some point in this class, so similar to doing a tax-free exchange, there's a section in the Internal Revenue Code called 1033, which deals with eminent domain. So if you've had land condemned and confiscated, you actually have a much more liberal period. You've got 2 years in which you can identify replacement property and reinvest it and not pay the tax on it. Okay, so they will take your land, but they're going to treat you nicely tax-wise. Okay, so they're going to give you an option. Now, here's one. The time may be right for more M&A in the REIT sector. So what are REITs again? What is a real estate investment trust?
It's either equity or mortgage.
Tax strategy.
So you should 90% of the shares.
So a REIT is essentially an entity that is elected under an Internal Revenue Code section to be treated under a particular scheme of rules for tax purposes, okay? But in this country, we kind of talked the other day that, especially publicly traded REITs was a mechanism to allow the masses to invest in real estate on the, play on the equity side, and now, more so on the debt side as well with some of the mortgage REITs that are out there. There's about, I don't know the exact number, 220, 230 mortgage REITs in this country. The bulk of them are equity REITs, okay? And so, I don't know the number, but there's probably 180 equity REITs and maybe 30 or 40 mortgage REITs or something like that. The lion's share are equity REITs, okay? How are REITs valued? How does the market value REITs? How do you value private equity, real estate? We talked about this the other day.
The underlying asset.
Yeah, it better be the underlying. Well, so we talked about, what did I say real estate was? I said it was land, buildings, and improvements thereon, right? But what did I say, in my mind, in a class like this, what was real estate?
Assets.
It was nothing more, it was a financial asset. And a financial asset was worth what? Nothing more, nothing less than the net present value of its future cash flows. And it can only clear the market at what price? At what price is real estate transacted? What's market?
Present.
I just gave you the answer.
Future value. Of the cash flow.
At the net present value of its future cash flows. Because would a willing buyer pay more than the net present value of its future cash flows? Would a willing seller sell it at less than the net present value of its future cash flows? So, what's the market clearing price? An appraisal?
No.
The market? I mean, yeah, the market. Oh, and by the way, listen, when I tell you in a commercial space where you got intelligent people with intelligent investors with spreadsheets, okay? When you look at a sale of a building or a portfolio, I can tell you from experience, somebody, a broker is going to, circulate. Let's say they'll put together 50 books. Let's say that 35 of those go out. Let's say 20 to 25 people take tour visits or site visits. I'm going to tell you probably 15 actually submit bids. In my personal experience, out of those bids, you could probably throw out 2 or 3 of them, but 10 to 12 of those bids are going to probably, say on a $20 million asset, are going to be within $100,000 of one another. Why is that? Because people know what the cash flow is, and people have very similar cost of capital, and hence people know what the net present value of those future cash flows are. And I'm just telling you, anecdotally, in my experience, that theory is supported. Okay, now, let's go back to the question. How's a REIT value?
Future cash flows.
Okay, now, can people really, look out and do that? Yeah, to some extent there are. Green Street is a firm that specializes in REITs, and I'm going to get to your question, although I'll go in a second, okay? And they will model, and they'll model on an asset-by-asset basis. The REITs will provide the, they'll give them the runs on their leases. They'll be able to model, and they'll estimate what the future cash flow is. Now, we may have slightly different ways in which we compose our capital stack. That may imply a slightly different cost, but in theory, a REIT should be valued based on the net present value of its future cash flows, right? I think that's how it should be. I want to stop there for a second. Eduardo, what was your question?
No, I was just asking if it wasn't that cap rate.
Well, so in the private realm, the easiest. So let's go back. It's a good point to interject that. So in the private realm, we're going to say, you know what? Office buildings are trading at a 6 cap. So that's kind of like what it's worth, okay? And we're playing with, expected IRRs, 8%, or, and again, going back to the style of investing I talked about the other day, they're core type assets. People are going to be saying, hey, yeah, the cap rate's going to be an indicator, but I better wind up with an IRR in that 6 to 7% range, okay? So that's how people are going to triangulate the value, okay? In the REIT space, yeah, you can value cash flow, but the problem is, most people don't have that cap rate in their hand. Most people don't have all that cash flow information. And so to some extent, REITs trade at the whim of the market, okay? And so REITs can trade on a multiple of price earnings, which is the inverse of cap rate. Okay, we talked about this the other day. It's the inverse of cap rate, so it's price over earnings instead of earnings over price, or NOI over value, which is how we defined cap rate the other day. Okay, so there's that, but people also talk about something called net asset value. And what's net asset value? So ultimately, like this Green Street, which is a REIT firm, they're going to ultimately say, hey, we think the net present value of all the cash flows here is X, and there's so many shares outstanding, okay? And so the value per share, the net asset value per share is X. It's the book value, or the market value per share. What do we think REITs are trading today? Do we know what REITs are trading in comparison to their net asset values?
Low.
Okay, that's a good guess.
Well, it's below 10.
Below 10. Below 10 what?
Price per earnings. 10
Oh,
times.
well, no, I would tell you most REITs still today, I don't have that number, but most REITs are trading higher than a 10 PE ratio, yeah. Yeah. Because remember, we think in cash flow in real estate, but when you do price earnings, you got to throw in depreciation, which is a huge number. REITs are trading somewhere in the 20s, but if you contrast it to net asset value, a lot of REITs today are trading below net asset value, and so they are trading below where analysts believe the true underlying value of the assets are. Now, that's an arbitrage play. At the end of the day, there are times, and we've seen this, and I've seen this over the last 30 years. There are times in which publicly traded real estate is more dear, more expensive, because the market values the certainty of that cash flow more than the private markets do. And what happens at that time? People start creating REITs and going public. And then you get situations now. What happens? Interest rates are going up. People have always equated, I think wrongfully, but people have equated REITs with debt instruments, and when interest rates start going up, they beat the prices down. So all of a sudden, public equity trades at a lower price than private equity. Then what happens? It's an opportunity for what?
Arbitrage.
Right, so it's either one REIT can buy another one, or private equity takes over REITs. And each of the last few weeks you've seen either M&A or going private transactions. So probably for a different class, but again, when you're an operator of real estate, am I sitting, where am I in that quadrant we talked about the other day, right? And you're typically, so do I have the right capital structure? Do I have the right debt to equity structure? And am I in the right box vis-a-vis, being in the public realm or private? Some of us by disposition or ability are not ever going to play in the public markets, but if we've got the ability, we may be able to maximize value. Really quickly, we haven't seen this here yet, but
Can you, so the net asset value was what?
well, net asset value by definition is market value by shares outstanding, okay? And you can apply that to anything. Do you own a mutual fund? No. Do you know what a mutual fund is?
I know what a mutual fund is.
People that are mutual.
Collection of different investments.
Hold on.
It's a collection of different investments.
Okay, so a mutual fund is it's the way people used to invest. It's kind of passe. It's like old people, but
fund that targets different companies or different
well,
things.
so they'll have a style or a focus, but mutual funds are pools of funds that are governed under the Investment Company Act of 1940, and they will take a collection of private individuals' funds and invest it. Most of them have some sort of style or strategy associated with them, okay? But when you buy a mutual fund, you can only buy a mutual fund when? At 4 o'clock in the afternoon. Why? What closes? The stock market in this country closes at 4, and what happens at 4? Now you can value. Now you know what the market value is of all of your holdings, and you know how many shares you have outstanding. So now you can say the net asset value is $10 or $15 or $18. So when you put your order for 10 units, now it's going to cost you 180 or 150 or whatever it's going to cost you. Okay? So that's net asset value there again. Okay, but it's market value divided by shares outstanding. Okay? This is an interesting one. I haven't seen it in South Florida yet. We talked the other day about the, the whole affordable housing issue. So in California, you now have initiatives to do what? Rent control. There's some vestiges of that still exist in New York and Philadelphia and Boston from.
Did you hear about the actress had an apartment?
Yeah. $28.
$28. She was in there. She moved in there like 1940 or something like that.
That's crazy.
It had the stove heater in there. Like she wouldn't let them do any renovations or anything. I forget what they called it. It had some kind of term that they called it.
So she knew that she felt embarrassed about the rent being so low.
Right.
So she never let them do any improvements. So she had no heat and no hot water.
Yeah.
Wow.
Eventually, there was a leakage, and the landlord was able to get in, and he put in. He spent $12,000 to put in a new heater and the hot, do all the plumbing for the hot water. She never used it because to her it was more fun to be paying 28 and getting all that. But the 12,000 was equivalent to the last 15 years of rent. So how can you make any money?
Well, and that's the only point that I was going to say is that, the article here says that California apartment landlords are dumping properties ahead of a rent control load. And so, obviously, if you have rent control, what's that going to impact?
Future.
Your cash flows, right? Your future cash
It'll just
flow.
be Europe then.
And it's, well, there's a lot of, it's kind of interesting. I threw away my notes, but I did some research for a class some years ago where there's a lot of different initiatives that, and really even down to municipal level in Europe, different countries or municipal governments use to foment or support affordable housing. And so some of it could be rent control, but in a lot of cities, you can't have apartments vacant for more than X amount of time, or there are huge fines associated with it, or they are subject to squatters coming in. And so, there's a lot of different techniques, and ultimately you go back, I don't want to say whether this is going to be Europe or not, but from a real estate perspective, we're a lot more like Europe than you think, sadly, but, and I'm sorry with respect, but, with respect, but definitely, if we have a problem with affordable housing and you're a politician, that's low-hanging fruit to bring rent control into place, okay? Because we've been trying all these different schemes that we throw billions of dollars at every year of subsidizing developers and subsidizing rents, and we still have a huge problem. So whatever we're doing isn't working, and the market is not working in certain places, right? It may be working in some place in West Virginia, it may be affordable, right? But it's not working in large cities in this country. So anyway.
Have you heard of opportunity funds?
I'm sorry?
Coming up now, like 2019, is these opportunity funds or opportunity zones, where it's kind of like social impact investing, where if you invest for 5 years, there's a certain percentage off your taxes. 7 years, there's a certain percentage off, and after 10 years, all the interest gains. That's pretty much.
What is that? I confess that I went on a trip one day. I went up to look at, it's very interesting, I went to look at something called an urban farm. So, inside containers, sort of climate controlled, light controlled environment. What is it?
Where is it?
Well, I went to Cincinnati, but these things are popping up everywhere. I read about this I first read about this about a year ago because there was a shopping center in Boston that was like kind of down on its luck, and it started renting a bunch of empty space to a guy that was putting up these containers, and this guy was selling to like 80% of the restaurants in the Boston area, the lettuce and tomatoes. And
he was farming in containers?
Yeah, farming in containers. So they were recycling, so this whole thing, you recycle the container. I don't know how many billions of containers come every year, but only 60% of them leave. Because we import all this, junk. So all these containers wind up here and are a nuisance. So, my old boss wants to do housing out of it, and his whole thing was, what?
What do you think about
doing housing with that. The problem that, and I haven't looked at the, I
It
haven't,
costs as much as building with brick and mortar.
it's more so, I mean,
You
he,
can close the doors and send them away.
they,
So they need to have special labor that knows how to cut them and all that.
yeah.
Close the doors and
Two,
ship
they
them
need to
away.
be treated.
Yeah, if you go back, I'll give you the numbers. I mean, what he's building, he's trying to do some housing for teachers at the charter school that they've developed in their community. And to do conventional multifamily in that area, fully loading it with the cost of the land, he's talking about $130 a square foot. To do it with containers, he's coming up with about $180, $190 a square foot. And so,
Why are
he
you?
may still do it from a social consciousness perspective. And then his other issue is, well, you know, not in the context of, you know, what you do, although he would provide subsidized housing for the teachers, but to just not get rid of containers and to show some. His other argument is that, you know, you got to do this stuff in scale in order to lower the costs, okay? And so, other than housing, people have started doing this farming with it. The place I went, they're actually using the sandwich board in the facility that I went, which is the original one. So, but you can do it in containers. So you've actually got a facility in North Carolina that's redoing 4 containers a month. Because these guys want to roll out that technology and put farms all over the country. The whole concept is, going back to ecology, why do I want to grow lettuce in California to truck it to Miami? Right? Look at all the, you know, the gas you're spending, plus you got to pick it how many days in advance, treat it with what to retard the spoilage, and by the time it gets here, it tastes like garbage, and the nutrients are gone. So their whole concept is we're going to put the food by where the people are at. And I'm going to get back to the opportunity fund in a second. So yeah, the only thing, my takeaway from this was it was phenomenal. The salad was awesome. Like, we went, we cut the lettuce, we picked the little tomatoes. It was awesome. The cucumbers, it was awesome. The problem is the costs associated with generating that revenue. I don't know if these guys, I think these guys have gone over the top in what they've done compared to some of the stuff I've read about. But, you know, they've just put, you know, millions of dollars into this infrastructure and it's not generating the revenue to justify it. So, now, on the way back on the plane, we talked about these opportunity zones, not funds, opportunity zones. So under the new tax code, or this revamped tax code, there's been this creation of these opportunity tax zones that have tax advantages that are similar to 1031 in the sense that investments in those zones have the same tax deferral capabilities, and even then some. So if you reinvest into a development zone and hold for 5 years, then there's a reduction on a capital gain on that gain. So the original gain is just deferred. It's not eliminated. It's on the value add after you make, and then if you hold beyond a certain period, then the whole gain is exempt.
Right.
And there's a whole map. I don't know anything about this, so if you want to research this and bring that to the class, I'd be happy to learn from you guys. But I'm not active in this stuff anymore, so I know that's as much as I need to know. Okay? We're gonna talk about accounting right now. So I know that's what you guys really wanted to hear. Was any of this stuff interesting? I mean, was this like, I like doing this in class because it keeps me active. Yes, Angela?
Oh, as far as the accounting, is that what you were asking if it was interesting?
No, I'm going to accounting now.
The pain.
I think Angela just woke up.
I have a question for you.
Yes, Danilo has a question for me.
Maybe I missed it, but finally, what was it that bridge loan were?
So a bridge loan is a loan. Yeah, you missed it.
No. Why is it that bridge loans have
Very low interest rate.
very low interest rate? Yes.
Yeah, you went outside. Well, Because bridge loans tend to be short-term in nature, and it's a matching of funds. So the lender is using short-term funds with variable interest rates, so they can only loan to you under that scenario. Now, you know, people can take some of that risk away using interest rate swaps, and so, you know, that there's blurred lines now between what's permanent, what's short-term, what's bridge, and whether it's fixed or variable, but historically, it's a matching of funds issue. Looking at the lender and what their balance sheet looks like, and the nature of their liabilities that they're funding their loan with.
I also have a question.
Yes, Luis?
Why some banks use the 6-month LIBOR and others use the 1-year LIBOR, 1-month LIBOR?
And some use HIBOR.
HIBOR?
Hialeah Interbank Offer. That's what Danilo uses.
Where you want to sell Miami?
In Miami, you use HIBOR. So, so LIBOR is just a broad term for the London Interbank Offer Rate. Okay, so again, that goes back to the rate at which banks in London loan from one, from one to another.
Correct.
But there's going to be different maturities on the type of loan that they have, and so if a bank is going to use a 6-month index, it's typically because you're on a 6-month or something similar to that term. And if you're going to do a 30-day arrangement, you'll probably be at a 30-day LIBOR, and if you're at a year, it'll be a year LIBOR. So it just has to do with maturity.
A big bank in the UK was questioning whether they were going to come up with their own.
It's a big scandal.
Right.
Yeah, so I mean, there's been a whole issue with bankers rigging. Remember what I did the other day with regulation, spawning innovation, and yeah, so there was a big scandal some years ago that I think Barclays in particular was behind fixing LIBOR and basically making money on that, and so yeah, there's an initiative to try to replace that with some other benchmark that is not subject to manipulation, but that somebody will figure out how to manipulate it, and then you go from there.
The companies I used to work, they always use, they always get a construction loan, and they have the 1-month LIBOR in the construction loan. How that relates to the maturity of the 1-month LIBOR?
Well, what the lender is basically telling in that scenario is we're going to assume 0 interest rate risk, and we're going to reprice that loan every month. And every month, they're going to reprice it.
So every month the interest is going to be different?
Yeah. Yeah.
According to the LIBOR?
Yeah. I mean, listen, any variable rate loan is going to be pegged, well, any. They're typically going to be pegged to some index somewhere. Okay? Think of it in residential loans. The residential variable loans are going to be indexed to some or pegged to some sort of index. And they'll reprice at a particular point, based on the movements in that index. And it's going to go up or down. Most commercial debt in this country, I'm not talking about real estate now, most short-term commercial rates in this country, working capital financing, typically backstopped by accounts receivable and inventories, reprices every month. And that's going to be pegged to a prime, which is what a bank would loan to its preferred borrowers, or prime plus something, and that typically reprices every month. Woody, you had a question?
No, but just a comment on the insurance loans.
Yep.
They mean business when they say you're not getting out of that interest that you owe them. My partner tried to sell a building over off of the Palmetto, like 3 years, 3 years early. And he didn't sell the building because it was just a moral thing. He was not paying the interest. And the bank, he had been paying them for 20 years. That insurance company was not letting him out of that interest.
No, again, there are benefits associated with dealing with life insurance companies, but people have any of you done have you ever worked with any sureties? It's a surety. Okay, we'll find out next week what a surety is and what a surety bond is. But a surety is kind of like an insurance company that provides performance bonds, right? And so people that work there, they're very sort of square. Life insurance company guys are very sort of square. Things fit in the box, and what's in the box works, and what's out of the box doesn't work. And it's that simple, and there's no give or take. That's just the way it is. So
When you have a construction loan, even though you want to start, you don't have a specific time when you want to start your project, can you lock the interest rate?
listen, everything is negotiable in life, okay? And so you can negotiate a construction loan that is going to have X term. So you can have a construction loan that, let's assume that you've got an 18-month construction period, right? So you might be able to negotiate an 18-month loan. A proven bank is probably going to give you a 24-month loan because they know stuff's going to happen and you're not necessarily going to complete it. And they don't want to, on the back end, have to redo the loan or be in default, right? You can maybe negotiate a 60-month construction loan.
Is that invisible?
Yeah.
Yeah. I didn't get a chance to go to.
I think you want to change it.
We need to get a black light.
I had a game last night, and
You need X-ray vision. I can see
Just
everything.
gotta get one of the black lights.
listen, I'm leaving, and I walk by the other team's bench, and they've got a big whiteboard with 3 brand new markers, and I came this close to stealing them. And I told Edward, I told the head coach, Edward, I'm going to steal those things. I got class tomorrow, and I haven't had a chance. But this one's better, right? So you might be able to negotiate a 60-month construction to mini permanent, okay, where a bank's going to let you draw down and at a certain point fix it, okay? No more drawdown and start repaying or interest-only payments. Anything is negotiable. Now, can you negotiate a fixed rate for that period? Yeah, you can. Yeah, you can. You can also negotiate a variable rate during that period. Everything's negotiable. It depends who you're dealing with, it depends who you are, and it depends on the perception of the lender and their programs. Yes,
So
Michael.
one of the things you talked about earlier was the interest reserve.
Yes.
But the way you gave it was in the context of a brand new construction. So I had an asset that was underperforming and we had to renegotiate. It was an existing product. So what the lender did for us to renegotiate the terms of the payments and all that, we had to set up an interest reserve. And because it was cash flow issues, we would pay what we could. And whatever was short, they would take out an interest reserve, but we had to maintain a minimum of the interest reserve as well. So when we did better, we had to dump some more into
So,
it.
that's right. So it's like a revolving line in that
Yeah, I
sense.
just wanted to say that just to give the context that it's not only in relation to an construction loan, but also.
And extending that, especially in situations of rehab, you might have allowances that are set aside for tenant improvements or capital improvements that you're going to make over time. And so a lender might say, okay, we're going to loan $10 million and we're going to give you a $2 million reserve that you can draw down to do TI on the dark space that you have as you lease it up. Or capital improvement because you know you need to do it in order to reposition the asset. Okay, so that whole reserve concept in a loan or an incremental loan or an ability to accordion or expand a loan is definitely available. Okay? Accounting is fun. It's fun. It really is. It really is. And so a lot of people are afraid of this. I think there's a few accountants in here, so we're not afraid of it because knowledge is power. Okay, and from that perspective, what I would say is a lot of people are afraid of knowing what accounting does, but then it inhibits their ability to excel in the business realm. Okay. My encouragement to everybody in here is if you have never done it or are rusty, that you take the time and make the investment in doing like an entry-level accounting class in any undergraduate program one night, like at Nova or Miami-Dade or Broward College or whatever, and spend one semester going once a week or twice a week and doing an entry-level accounting class, because you will learn almost everything you need to know in those classes. You don't need to know how to do, fair market valuations and things like that. Most people are not going to need to know that, but understanding how financial statements are compiled, understanding what financial statements are, and then understanding relationships that exist between those numbers and those financial statements will go a long way towards helping you analyze and ultimately make decisions related to business. Okay, the example, and I'm going to use this in two different ways. I felt handicapped when I got into the real estate industry because I'm not a construction guy and I'm not an architect. Construction plans are hard for me to read, and so I've gotten better over time. Actually, I had some work done at the house, and I had to go back to the original plans this week because the GC wasn't doing what they had to do, and I figured out what I needed to get done. But I remember that the head of development and construction in our business was a very talented, intelligent guy who was an architect by training, had been working for 25 years in the construction business, and knew nothing about financial statements.